Hi everyone. In today's video, I am going to explain currency exchange rate in very easy language so that even if you have zero finance background, you will still be able to understand. And by the end of this video, you will be able to understand how world's money system actually works and how it affects petrol prices, your iPhone costs, your investments, and even your dream vacation abroad. So, grab a notebook and let's demystify currency exchange together. Okay, so let's start super simple. Imagine you live in India and you are planning a trip to the US. Now you want to buy a coffee, but you can't pay for your coffee at Starbucks there with Indian rupees, right? So you will need US dollars. So what you do, you take your rupees to a currency exchange counter or your bank and they give you dollars based on the current exchange rate. Now what does that even mean? Let's say today 1 US dollar is equal to 86 Indian rupees. It means if you give them 8600 rupees, you will get $100. But here's the twist. This rate doesn't stay the same. So one day you may get $100 for 8600 rupees and another day you might need 8500 rupees for the same $100. And that's what we mean by currency exchange. It's basically converting your money from one country's currency to another. Now let's talk about why do these rates change every day? And sometimes they even change every hour. So it's all about supply and demand. If lots of people and businesses want US dollars, the demand for dollars increases. And as the demand increases, the dollar becomes stronger compared to the rupee or other currencies. And in the same way, if fewer people want the dollar weakens. So now let's talk about some of the main reasons for such currency fluctuations. Let's start with interest rates. Think about it like this. If a country is offering higher interest rates, investors around the world want to park their money in order to earn better returns. When the US Federal Reserve increases interest rates, investors rush to buy dollars to invest in US assets, which increases the demand for the dollar. For example, in year 2022 and 2023, the Fed hiked interest rates aggressively and we saw the US dollar index hit 20-year highs. Next is inflation. If a country has low inflation, the value of its currency remains strong because it retains purchasing power. Countries like Switzerland often have stronger currencies because they maintain low inflation rates and a stable economy. If inflation is high, foreign investors lose purchasing power, so they avoid investing in your currency, which in turn weakens the currency. Now, political stability. Imagine you are an investor. Would you put your money in a country with protests, government instability, or a financial crisis? No, right? Investors trust stable governments. And if there's political uncertainty, people move money out, which weakens that country's currency. For example, the Turkish lira fell massively during political tensions and policy uncertainty. Next up, economic performance. If a country's GDP is growing, businesses are doing well, and employment is strong, so the investors see potential and hence they want to invest in that country, which increases the demand for its currency. For example, India's growing economy often attracts foreign investment, which helps in stabilizing or strengthening the rupee despite all the challenges that we have. Now let's talk about trade deficits and surpluses. So, if a country imports more than it exports, which leads into a trade deficit situation, in that case, it needs more foreign currency to pay for those imports, right? Which puts pressure on its own currency. And conversely, if it exports more than it imports, it leads to trade surplus situation, which in turn increases demand for its currency and helps in strengthening it. For example, Germany often runs trade surpluses due to strong export of cars and machinery, which in turn supports the euro. Now, you might think that currency exchange is only for travelers, but that's not true. It's everywhere. So, if Tata Motors imports machinery from Germany, then they will need euros. So, they will exchange rupees for euros at the current rate. If you want to buy Apple shares, you need dollars. And for example, for multinational companies like Apple, Amazon, Infosys, they all deal in multiple currencies. And then there are people who trade currencies to profit from small changes in rates. They are called forex traders. Then we have central banks like the RBI or the Federal Reserve. They intervene in the markets to stabilize their currency. Now, here is a real life example. In 2022, the rupee weakened and the petrol prices in India increased because we know that crude oil is imported in dollars. And when the dollar becomes stronger, it costs more rupees to buy the same amount of oil. Okay, so now an important question that comes up is, who decides what $1 equals in rupees? Or who sets these exchange rates? Like, is it the government? Not really. So, exchange rates are decided in the foreign exchange market or the forex market, which is also the world's largest financial market where currencies are traded 24/7 across different locations like London, New York, Tokyo, Singapore, etc. Every second, traders, banks, businesses, and governments are buying and selling these currencies, and these actions determine the exchange rate. Here's a fun fact: around $7.5 trillion is traded every single day in the forex market. And sometimes central banks step in to stabilize rates, like how the RBI buys or sells dollars to control rupee volatility. But most of the time, it's market driven, like stock prices. Now, let's quickly discuss what we learned today. So, we learned that exchange rates are the price of one currency in terms of another, right? And they change based on global supply and demand factors. And it is the forex markets that decide exchange rate, not one person or any government. And also, currency exchange impacts travel, investment, prices of goods, and your daily life. So, if you found this video helpful, let me know in the comments what part you found the most interesting. Also, should we do a video on how to read currency codes and understand bid-ask spreads next? Let me know in the comments, and I'll see you in the next video. Bye bye.